We want to turn our attention to what is known as private capital's most senior gathering. Nearly 2,000 attendees with more than $50 trillion in assets. They've come together in Berlin for this year's SuperReturn International. And that's where we find our own Leslie Picker. And she's joined by a special guest for a first on CNBC interview. Leslie, good morning.
Good morning. Thank you so much. Yes, Julian Salisbury, Co-CIO of Sixth Street, manages about $100 billion of those assets you just outlined. So let's start with the macro, because you oversee a bunch of different asset classes. So I'd love to get your perspective on what's going on the broader economy front. So we've got multiple Fed officials raising alarms, raising concerns about the risk of stagflation. They say that tariffs haven't yet had an impact on pricing, but that could change in the coming weeks. Have you gotten any sense from the portfolio companies that you work with and the borrowers that you work with that could be imminent?
Look, I think when we look across our portfolio, you have to think about first-order effects, second-order effects, and have some humility about the uncertainty that exists in the market today. When we look across our portfolio today, generally the first-order effects are still pretty muted. Part of that is about industry selection that we focused on, so tending to more focus on technology, healthcare services type businesses that are less directly exposed to that. But I do think it's still early to say about the longer-term effects of tariffs, and I think we all have to be aware about the broader impacts on the economy. Nobody's going to be immune to this. Like, uncertainty is never great for investment, it's never great for consumer expenditure, and it's going to be many months before we see this fully roll through the portfolio, I think.
Also, kind of sticking with the idea of the macro picture, and in particular what's going on in Washington with the deficit right now. We had Jamie Dimon speaking last week saying that he expects there to be cracks in the bond market as a result of just these exorbitant levels of national debt. Is that a concern of yours, and how does that impact, if that does indeed happen, how does that impact the private credit investing landscape?
If you look at how Sixth Street was formed, we were designed really to operate in any market environment. We are macro aware, but the investments we're making are not typically predicated on a particular move in rates or FX or commodity prices. We generally try to hedge that out. That being said, you can't ignore what's going on in the bond markets. At the end of the day, all risk prices off of the risk-free rate, the treasury rate. We actually think a harder environment when rates were bounded at zero and everything was moving up and to the right, that was actually a particularly tough investment environment for us. What we're finding right now with rates higher, and we think remaining likely to come lower from where they are right now, but to stay structurally higher than they've been over the last few years, it's going to result in a greater dispersion of performance. It's going to result in asset selection actually mattering. So we actually feel that that's a pretty exciting environment for us. When I look back over the years, some of the best investing periods for us have been when uncertainty's been at the highest. It's been, in 2020 was a great deployment year for us. And what you actually want, when things are absolutely dissipated and collapsing, transaction levels tend to stop, and that actually makes deployment hard. But a kind of muddling along, higher for longer environment, I think creates a good environment for us.
Interesting. I think Frank has a question for you back in studio.
Hey, Julian, how you doing? This is Frank Holland back at CNBC headquarters. Thanks for joining us this morning. A lot of talk there about an end to U.S. exceptionalism. We've seen some signs in the currency market. The dollar's down about 9% since the inauguration. How does that shape your view of emerging markets with the idea of a softening dollar, and how does that shape your view of Europe with a rising euro?
So, great question. Around October, November last year, it felt like people had almost thrown in the towel and just said, we've just got to go all in on U.S. growth. And, that was never the right answer. If you look towards the end of last year, our view was, when you looked at the valuation gap that had actually emerged between U.S. and Europe over the last 10 or 15 years, just given the structural environment and the relative lack of capital available in the market versus the U.S. And yet, great businesses that exist both in Europe and in Asia, that this would set up for a good environment for us. So if you come into this year, what's really happened? I'd say two things. One, people became more cognizant of the magnitude of that valuation gap. The gap had just gotten too wide, 30-40% premium in certain cases. Second, this divergence in fiscal performance where, US looking to cut expenses, cut spending, Europe on the other hand looking to invest more, especially in defense. And then the third thing, just from a geopolitical perspective, I don't think the US exceptionalism story is gone. I mean, it's still the biggest, the best investable market in the world. Great rule of law, transparency, great talent, just a real depth of companies that you can invest in across sectors and asset classes. But I think a lot of people were just starting to say, well, you know what, I've kind of gotten overweight, just given the outperformance of my US assets over the last 5 to 10 years. Maybe there's a chance to rebalance. So a lot of people on those marginal decisions are saying, maybe I should be looking at Europe and Asia now, both as a diversifier, a rebalancer, and just recognizing that those valuations have gotten out of whack.
Yeah.
So we think it's a good investing environment outside of the US.
It really feels like a massive narrative shift here at SuperReturn from last year, where everybody was still in that US exceptionalism camp. At least it felt like that. And this year, there is more embracing of opportunities in Europe. Kind of speaking of bigger trends that we see here at SuperReturn, private credit each year keeps generating more and more airspace at this conference, just given the growth in that area. You guys are obviously huge players and early players in private credit. So I want to ask you what you think of some of the recent warnings, whether it's from the Fed, which just had a report showing the enormous interconnectivity between private credit and the financial sector, or Moody's, which believes that the next crisis could come from private credit. What do you say to reports like that are sounding such alarms?
Yeah. So first of all, I think something like 85% of all companies in the US with more than $100 million of revenues are private.
Right.
So there's a huge need for capital for those companies. And notwithstanding the fact that the regulatory environment for banks looks like it's going to be easing, there's a huge need for capital in that space. Second, I think there's a secular demand growth from all forms of investors, institutional investors, insurance investors, wealth investors, to have exposure and interest in this asset class. When you have that level of capital flowing in, and the way it's flowing in, so you've seen massive growth, specifically in direct lending capital over the last 4 or 5 years, a lot of it in evergreen fund format, which means that money has to be deployed right away. It's naturally going to give rise to some concerns and questions. And I do think that particular part of the market is tricky right now. We like the way we're set up to play that. We don't, the way our capital is organized, it allows us to be able to fade at points like that and reallocate capital towards things where we're seeing greater rates of returns. But look, when that much capital comes in, there's definitely a level of complacency in the direct lending market specifically, but credit's a much bigger asset class than that. There are opportunities in ABF and opportunistic credit and real estate lending. So we're really, our aperture gives us an opportunity to fade markets when we see there's too much capital and look at other areas.
Yeah, and you've seen both sides because you now work for Sixth Street in kind of the private credit space, coming from Goldman in the more regulated banking space. Julian, thank you so much for being here from
Pleasure.
SuperReturn.